Let's talk about a part of the equity market where maybe it's not happening. Maybe that story is starting to change, and that's retail. We just heard from Lowe's a moment ago. They've affirmed their outlook. We'll hear from Macy's in just a moment as well. Target coming out before earnings and turning around and reducing prices on 5,000 items and talking about a consumer that's pressured speaks to a loss of pricing power in US retail, Max. Is that just one part of the economy, or is there a broader story starting to emerge there?
I don't think it's a broader story. I think it's one part of the economy, and surely, yes, there are pockets of weakness. Absolutely. There is pockets of weakness among perhaps the lowest income households, you know, the ones that feel the strain the most from higher rates. Absolutely, 100%. But that doesn't mean that it's a broader story. It just means there is more differentiation in the economy. So I keep telling people, look, for 10 years in the 2010s, we've been complaining that everything is a one-way street. Everything is basically just a trade for ETFs and passive investing. And, you know, what happens in the economy doesn't really matter anymore because there is no longer any differentiation because we've got the last buyers, the central banks, active everywhere. That is no longer the case. Now we're starting to see some pockets of weakness on one part of the economy. We're seeing pockets of continued strength. So the growth, the tech companies, that still is showing really, really good signs of strength there. So to me, it just means there's more differentiation. It's a return to the old normal world. It's not really a return to any kind of, oh, is this a sign of a next crisis or next recession break? Absolutely not. It just means there's more differentiation and actually more opportunities for alpha creation.